Tesla is once again facing serious headwinds in China. After a short-lived rebound, July deliveries from its Shanghai Gigafactory dropped, showing that the US EV giant is losing ground in the world's most competitive electric vehicle market. Ironically, Tesla's share price climbed this Monday after the company granted CEO Elon Musk 96 million new shares, a payout worth nearly $30 billion. But behind the scenes, production in Shanghai is slowing for the first time in years. Every idle robot arm on the assembly line is a warning sign that Tesla's dominance in China's EV kingdom is being challenged. Aggressive price cuts from BYD, rising lithium costs, and intensifying competition have created what some call a triple squeeze for Tesla. The question is, can Musk break free from this pressure and restore margins, or will the Gigafactory's growth story start trending permanently downward? July 2025. The turning point official figures showed Tesla's Shanghai deliveries in July fell to their lowest level in 18 months. Total domestic sales for the first 7 months of 2025 are more than 40,000 units behind the same period in 2024. While the year-to-date drop is just 8.4%, a deeper look reveals three major problems. Shrinking profit margins from constant price cuts, the scale advantage of local rivals, rising raw material and energy costs. These factors are interconnected, amplifying each other's impact and forcing Tesla to rethink its financial strategy. Price cuts that hurt more than helped. Back in late 2020, Tesla surged to the top of China's EV market, with sales rising steadily until late 2024. That's when competitors like BYD, SAIC-GM, and Jack unleashed aggressive discounts. Tesla responded by cutting prices on the Model 3 and Model Y, which initially helped retain market share but steadily eroded profit margins. In April 2025, factory prices were lowered by another 4 to 5%, bringing the base Model Y down to the same price as some domestic dual-motor sedans. The bump in demand was small, but the hit to after-tax profit was significant, setting the stage for the summer sales slump. Local competitors outpacing Tesla. Chinese automakers, led by BYD, have been expanding rapidly by using battery vehicle integration, placing the battery directly inside the chassis to save weight and cut costs. This design gives BYD a major production cost advantage. Tesla has tested a similar structural battery for the Model Y using its 4,680 cells, but the large-scale rollout is still incomplete. As a result, BYD's market share has grown while Tesla's has dropped from 16.5% in late 2024 to just 13% by July 2025. Raw material prices bite back at the end of 2023. Falling lithium prices led many to predict a profit boom for EV makers. But by early 2025, lithium, nickel, manganese, and cobalt prices started climbing again, hitting Tesla's long-range NMC battery models especially hard. Tesla plans to expand LFP battery production by year-end to cut costs, but so far, savings have been limited. Currency and energy cost pressures. A weaker Chinese yuan against the US dollar has reduced Tesla's reported revenue in local currency terms. On top of that, China's updated electricity tariffs for high-energy industries have increased costs for processes like cathode drying, adding about $100 in extra energy costs per vehicle. Tesla is trying to offset these costs with solar power from its own facilities, but efficiency depends heavily on seasonal daylight hours. Export strategy and model gaps. Tesla has shifted more Shanghai production toward exports to Australia and South Korea to make up for weak domestic sales. But EU carbon tariffs on Chinese-made cars have cut export margins compared to vehicles from Tesla's Berlin plant. Meanwhile, Chinese consumers are moving toward cheaper B-segment sedans and small crossovers, a category where Tesla currently has no offering. The company's new entry-level model won't be in production until 2026, meaning Tesla could keep losing share until then. Margin erosion and investor caution. Tesla's Chinese gross profit margin fell 3.77 percentage points in Q1 and slipped another 0.4 points in July. While the Megapack energy storage business is growing, it's not enough to offset falling vehicle revenue. The company's 2025 China sales target of 900,000 units now looks more like 820,000 to 830,000. This could push global delivery guidance down to 1.8 million. Short-term moves versus long-term fix in the near term. Tesla is switching some supplier contracts to yuan to cut inventory costs, sharing service and sales centers with dealers to reduce expenses, bundling low-value features as accessory packages to improve margins, but these changes won't fully solve the deeper volume and profit issues. Long-term, Tesla's solution likely lies in a new mass market model to compete directly with BYD's price-volume advantage. However, sources suggest this car may be built in Mexico or Berlin instead of Shanghai, meaning Tesla won't fully benefit from Chinese scale efficiencies. The road ahead. Geopolitics makes the challenge harder. US-China trade tensions threaten both supply chains and market access. US-made Teslas can't be sold in China, and China-made Teslas can't qualify for US subsidies, creating permanent extra costs for the company's global operations. Tesla's management insists they can maintain the delicate balance of cutting prices, reducing costs, and continuing R&D investment. But in China's fiercely competitive EV market, keeping all three plates spinning is harder than ever. If Tesla can't rebuild its profit volume technology triangle soon, the weak July 2025 results could mark the beginning of a long-term decline in its most important international market.